I will upload this lecture after completing it here, and I'll share it on YouTube, because we don't know if there is a problem in between. So there are 3 files. One, the PowerPoint presentation. The second is a Word file with the set of questions. Now, these set of questions which are there on the Word file, you will submit, I don't know, these questions. This this is what we should plan for the classes, all classes, that we are able to solve all the questions after the class. So we will spend half time or some slightly more on understanding the lecture, and then we will try to solve the questions. So this way it will become more interactive, and we will check if we learned. So let's start with you can all see the screen. Can you see the screen? Okay. So we are going to learn. We already completed the stock market. Stock market was a type of capital market, and the main issue and the main feature of the stock market was that it belongs to the capital market, and the life of the instrument is more than 1 year. Yeah, Shama is right. Don't worry. I am recording the lecture, so I'll share it on YouTube. Don't worry at all. Just if you don't hear, no problem. But it's better we continue on Blackboard, unless it's not good for everyone. Let's continue on this. In money market, the life of the instruments is how much? Less than 1 year. So these money market instruments have a life of less than 1 year. So that is one market we have to learn. And the second financial market that we'll try to cover quickly today is the bond market. The bond arises from the debt, the loans, the loan market. So these are the two. That is our target, to complete both of them today. So let's start with the money market. So what is money market? Money market is a market of buyers and sellers of financial securities, where the maturity or the life of the instrument, maturity, everybody understands, maturity and life are same. Like you see, in normal products, what do we say? Expiry date of products. Similarly, for financial products, we call it maturity. When will the product expire and we will get back the value? So in the case of money market, the maturity of the products is less than 1 year. 1 year or less than 1 is traded in that market. And another feature of money market, so you got the idea. Number 1, it is different from capital market. Capital market was for more than 1 year, in which we studied stock market. Money market is for less than 1 year, and here the main characteristic, main feature of the market is high liquidity. High liquidity, very fast you can get back the money. All right, we invest the money today, and and the life of the product is just 1 day, 3 months, 6 months, not more than 1 year. So, we can easily convert the money into the instrument into money. And also in this market, like you remember in the stock market, we were able to share buy the shares for low amounts, 32 reals, $38, etc. But in the money market, small amounts are not allowed. The transactions take place in large amounts, huge amounts. So, that is another feature of the money market. And lastly, money market transactions generally take place among large institutions. Individual investors are not allowed in the money market. Like if we want to participate, not allowed, we cannot participate in simply like as we did in the stock market. For money market, we need to have huge amounts to participate, and it is normally done by large institutions. Okay, so let me just check what do you understand by maturity, so that I can see if you heard me properly. What do we understand by maturity? Who will answer me? Yes. Yeah. The date of expiry of financial products is called maturity. Very good. So, I am happy that it is working. I hope others can also hear me properly and they are understanding. So, in capital market, we were dealing with products, financial products, financial instruments of maturities of more than 1 year. In money market, we are dealing with products having life or maturity of 1 year or less. Second feature, if I ask you to tell me second main feature of the money market, what is it? First is 1 year or less, the second high, yeah, very good, high liquidity because it's in short time. So, the liquidity is very high, we can easily get the money back. The third main feature of money market is what? High, huge amounts. It cannot be done in the way we did with the shares. We purchased the shares for 32 reals, $30. But in the case of money market, the amount has to be huge. It has to be in millions, in billions, and that will be because the returns, for example, if we are getting 10% return per annum for 365 days, and this instrument is only for 1 day. So, you can understand that $32 will not give any return at all, only 0.00 something. So, that is why it does not make much sense, but for large amounts it really makes sense, and it is a short term market, short term credit market, where one can take money and buy the instrument. So, these are the characteristics: high liquidity, default risk, more efficient source of credit for largest institutions. Now, the question is, who can participate in money market? Number one, commercial banks. Commercial banks, all of you understand because you already have learned this course, this topic in detail. Commercial banks are like Al-Ahli or Raji, Bank Al-Inma. Central banks are the regulators, SAMA, or the Fed Reserve. These are the banks who also need money. For example, you see right now many governments of the world, it's a strange situation the disease has caused for the world. The entire world is at still, movements are stopped, stock markets are crashing. Now, in this case, the governments may need money, so they cannot take the money directly. They use central banks to take money from the market. So, they also can take money, central banks, and also non-banking financial institutions. If you remember, we discussed this. How many of you have already taken banking course with me? Have you completed banking course earlier with me or with anyone? Have you finished? Yeah, so you remember what is the difference between a normal bank and a non-banking finance institution? Can anyone try? Who will tell me? You can also write on the group if you wish, like. Difference between a commercial bank and a non-banking financial company. Yeah. Tell me, try, what is the difference? You wrote in the chat. Okay, I'll check. Yes. I think non-financial, like insurance institutions, but non-financial institution just can give loans. Yeah, yes, USRA. USRA is right. USRA is close. The Basma has given the first answer. Banking institutions can take deposits, but non-banking institutions cannot take savings. That's the most important difference. USRA also is right. Rava, I think non-financial like insurance institution and commercial like Al Ahli, but non-financial institution just gives loans. Yeah, the non-banking financial institutions can give loans, they can give insurance or any product, but they cannot take savings from the public. That's the main difference. Now, we got 3 participants in the non-bank, in the money market. Now, let's come to this point. How does money market help the borrowers? Because whether it is money market or it is capital market, in the market the buyers and sellers are meeting. So, the seller here is one of these participants who need money. So, they have 2 options. We learned in the earlier classes also that they can borrow money from the bank. So, what is that's the easiest way to borrow money from the banks, because banks are ready to give you loan. So, the companies can go, banks can go to another bank and take loan. It's possible, that is something you may learn in higher classes also in banking, how the banks take loan from another bank, how the banks take loan from central bank. So, that is one option. But The money market provides another option, that is, it plays an it provides the funds available for short term, and the good thing is that the rate of return, or if it is fixed interest, it may be return also if it is traded on profit loss basis. It is varying, it can sometimes be more or less. So, it is not fixed, banks do not fix it, it is fixed by demand and supply. So, the most important advantage is that it is very helpful in national and international trade. It makes funds available for short term, because there is no other institution. If you go to a commercial bank, they will normally, as a borrower, they will not have a loan for 1 day or 2 days or 3 days. A company or a bank has to use other means to take such short term loan. So, money market provides loan for very short term basis, 1 day, 3 days. Let me just explain you slightly more. In banking, if in case you get to work in a bank, you will see that one of the main functions of the banks is to give money, because people come to withdraw money, their savings, and every day there is a transaction of cash. This is a very common need of the banks, that sometimes they need money, because all of a sudden tomorrow there is a demand for more cash and they do not have immediate cash. What they do? They take money from other banks. This is a very common practice, and in sometimes they may have excess cash. So, what they do? They give the excess cash, they invest the excess cash for 1 day or 2 days to another bank, and this is a very common practice in the banking. This is helpful for the banks to meet daily needs, operational needs. Such a need banks can also fulfill by the money market. So, this market provides the funds for short term. Banks and other firms can invest for short term, they will get return, because there is no other option to invest for 1 day or 3 days or 6 days. Minimum, there is a time period 7 days in banking. In a financial market, normal individual, if the person wants a return or interest, she has to invest the money minimum for 7 days, because in any bank in the world, they do not pay any interest for less than 7 days. If anyone wants to get interest for less than 7 days and it is a big institution, then they have to go to money market. It helps the government also meet short term requirements like printing of currency or borrowing from central bank. If they cannot do it, like the government will order to print currency, but rather they can take the money from the money market, and it encourages liquidity. The money market provides high liquidity, but also there is a problem of defaults. There can be problems of defaults, because this is a market of buyers and sellers. So, it is possible that the buyers are not able to return the money on time. The money market also helps in reducing the use of cash. Now, let us come to a very important part of this market. What are the products in this market? So, we should be familiar with, we cannot understand each of them in detail, but what we should aim at right now is to familiarize ourselves with the instruments, the products in the money market, because they are essentially the same. They are traded in the money market, they have a life of less than 1 year, and they have no fixed return. It depends upon the demand and supply. So, what are the common products in money market? Number 1, commercial paper. Number 2, treasury bills. Number 3, bankers acceptance. Number 4, certificates of deposit. Number 5, the certificates of deposit here, there is a mistake. This is a part of it. The certificates of deposit may be tradable or non-tradable. Meaning, tradable, trading, you have heard of it, trading. Trading, we heard in stock market that after the shares have been issued in the primary market, then it is traded. That means there is an option for the buyers of the shares to trade, to sell again in the market. That is called tradable, negotiable. But there is a possibility, or in the certificates of deposit, they may not allow trading. So, if the buyer purchases certificate of deposit, then if it is not tradable, non-negotiable, she or the buyer has to keep the certificate of deposit till the time of maturity. They cannot sell it, they cannot resell in the market. Then repurchase agreements are there. This is also a money market instrument. This is a short term contract in which the seller agrees to sell government security to a buyer and buy it back on a later date at a higher price. This is pure, this simply interest that we are seeing, which is practically not allowed in Islamic countries as per Sharia. We don't use such instruments which directly give riba. Still, this is a practice in the financial market in non-Islamic countries, where they will make a contract, the seller will sell the government security to a buyer, and then later they will rebuy at a higher price. Then there are last type of instrument is the money market mutual funds. Money market mutual funds. Before we learn about the money market mutual fund, let's just try to again understand mutual funds. What are they? Try to understand this carefully. Mutual funds there is something, okay, mutual funds. I thought somebody has answered about it. Anyway, no problem. What are mutual funds? See, after the share markets, mainly share markets, the selling and buying of shares became very common, a very popular source of investment in the market. Are you trying, anyone? As the share market started to boom, what happened was the investors were trying to buy shares, but the problem with shares was that with a small investor who has 1000 riyals, who has 10,000 riyals, can buy one share, one company's share or two companies' shares maximum. And when we buy less companies' shares, the possibility of loss is high, because we just have two shares. This price of share may go up or may go down. So, it will have been better if we buy shares of different companies. But the problem is how to buy shares of different companies for 10,000 riyals, because the share price of one company itself is 1000. So, we can only buy 10 shares of one company. So, when this need, we all know that in marketing, The need is the main thing, most important factor for developing new products. So, when the financial market found that there is a need for a product where the investors can buy shares of different companies, more than 2, 3 many companies. So, with 10,000 reals only, I am able to participate or buy the shares of 100 companies. What happens? The more we diversify the risk, the better it is. So, these companies started to exist. These companies came into picture called mutual funds. What they did, they took money from investors. Try to understand this carefully, and if you are not hearing me, let me know. Will you take the attendance in Blackboard? Yeah, of course. This attendance is with me now. Sarah cannot hear anything. Yes, okay. Right. So, these companies came into picture. What they did, they collected money from many people who wanted to buy shares, and after they collected the money, they will then invest in shares. They will buy shares of one company, second company, 100 companies, and the profit they make, they will keep some profit with them and share the rest profit with the investors. This became a very good medium of investment for all. It was a win-win for all, because these mutual funds were run by experts. They were more, we are investors, we do not know how to predict which company will do well tomorrow, but these mutual fund companies, they were run by experts. So, they were able to analyze well which companies will do well tomorrow, and so they will buy shares of this company, they will select shares carefully, and they help the investors to make profit. So, these companies are called mutual funds. They collect money from the investors and then they use their expertise to invest in shares. So, these are the money market instruments or money market products available for the investors, but we already learned that. Now, okay, one more clarification. This is all about money market mutual fund, but the mutual funds, normal mutual funds, they help the general investors. Money market mutual fund is only for the money market investors. They will invest in money market because large amounts are required. They will invest in money market. So, this is not much of use to a small investors in the money market mutual fund. It is again good for the investors with huge money. All right. So, we have covered so far. Let us first complete the question and answer, or no, let us complete this lecture first and then we will, because it is better to switch to Word file later. Okay, the second market. A second market is related to bonds. In money market is more related to short term products less than 1 year. Bond market is for long term debt security. Debt, in other words, you can write there loan security. So, the bond market, and whenever we are learning about the markets, you should immediately answer or keep in your mind. You should add a sentence there, market to buy and sell bonds. So, bond is a long term debt security. When I give loan to someone, then I can issue a bond. When I take loan from someone, I can issue a bond, and that bond is a guarantee, that is a contract. And now this contract can be sold or purchased in the financial market if it is tradable. So, if it is tradable, you can sell this bond in the market. It can, and again, just to revise, how does it help? The trading, how does it help? It helps because of the ease of liquidity. I am the buyer of the bond. I gave loan to someone. I have this paper. Now, I am in need of money. The bond is for 5 years maturity, but I need the money now after 6 months. What I do, I sell this contract to someone and take the money. I go away with my money. Now, this money, which was to be received by me after 5 years, now this person, the third person, will receive it because I have sold it. And in the bond market also there is a return. There is a return. So, it can be sold or purchased. So, the bond market is a market where participants can issue new debt or buy and sell debt securities. It is also called credit market or fixed income market. There is a fixed income in the bond. There is a return which is fixed, 10% or 20% or 15%. And the primary goal of the bond market is to provide a mechanism for long term funding of public and private expenditures. So, why are bonds issued? Bond is also normally not issued by individuals. If you and I want to sell a bond, it will not be sold because there is no guarantor. Normally, the bonds are sold or issued by governments, big institutions, and it helps in the long term funding of public and private expenditures. So, what the government does, normally governments, you will see, they sell bonds. They need money from the public or from anyone. So, what they do, they need $1 billion. They will divide this into bonds, different denominations, and sell it to the public and raise, and this is a type of a loan, different from shares. So, in the case of bonds, one party is called borrower, the issuer of the bond. Borrower, the person who takes money, who promises to make payments of interest and principal. This is the borrower, and on specific dates to the lenders. And the person who gives money is called the bondholder. Now, the bondholder, first of all, the first person, the primary bondholder, and then he will keep on selling. So, they will be the secondary bondholders. Who can be the issuers? Governments, state and local governments, corporations, foreign governments or corporations. These are all the participants in the bond market. Very importantly, we should know what is sukuk. Sukuk is Islamic bonds. Like we just now saw that bonds are what? They are another name for, who will tell me? They are simply another name for bonds. Yeah, what is it? What is simple name for bonds? What is it? It is a I think somebody is writing on the chat. Let me see. Very good, very good. Basma Lagamde, loans. Excellent. Bonds are loans. And in loan, generally what they do when we give loan, we give interest. But in the Islamic principle, we don't give interest. So in the Islamic world, they developed a new type of an instrument, new type of a bond called sukuk. And this sukuk, we are not going into details, we just want to be familiar with the term, how it operates. But if you want to learn, you can do more research on this, how it works and what are the returns, etc. How are the returns calculated? This is a financial certificate similar to a bond in Western finance, but this certificate, this loan complies with Sharia or the Islamic religious law, our Sharia. And this became, so if you are interested, you can do your research. Now, sukuk is a good instrument. It is very famous now in the Islamic finance, and also not just Islamic finance. There are many non-Muslim countries who have purchased. Dubai is a big market of Islamic finance. They sell shares, they sell sukuk also, and there are buyers who are non-Muslims also who buy sukuk to invest in the market. Now, last part of the bond market, we will see what are the different types of bonds, different types of loan contracts. So, this is important for us to learn. These are the different names of bonds, types of bonds on the basis of returns. On the basis of returns, there are two types, zero coupon and floating rate. Zero coupon bond pays no annual interest on the bond, no annual interest. It is one time. It provides compensation to investors in the form of capital appreciation. There is no fixed interest, but what happens is after 5 years, you invested 100,000 and you will get 120,000, but there is no fixed annual interest on it. Floating rate bond is that in which the coupon rate fluctuates with shifts in the general level of interest rates. Here what happens? In the case of floating, the level of no annual interest. Yeah. The case of floating rate, it is linked to the market. Now, it is simply, it's more or less like shares. What happens is the value of the bond, the price increases or decreases. So, the returns will increase on the basis of market supply and demand when it is being sold in the market. So, a bond whose coupon rate fluctuates with shifts in the general level. So, for simple understanding, try to remember that in the zero coupon bond, there is no fixed annual interest, and in the floating rate bond, there is a level of interest rate which is attached to the market. It is determined by the market, but there is an interest which is paid to the investor, but it is attached to the market. So, these are two types of bonds on the basis of returns. Then there are bonds which are based on issue. There are three types. Number one, domestic bond. So, a company issues a bond in the country of origin. This is called domestic bond. Like example is given, IBM issues a bond in the USA, or here in Saudi, there will be a Saudi company, or the Saudi government issues a bond inside Saudi. This is called domestic bond. International bond, a company issues a bond in another country, like IBM issues a bond in Japan. This is called international bond. And Euro bond are the company issues and sells a bond to investors in many different countries simultaneously. This is called Euro bond. It is not only, one should not get confused with the name Euro bond meaning only Europe. No, it is the bond which is, it is a product which is sold to different countries simultaneously, and rest of the details I will not explain because you will get confused. Just remember these three: domestic bonds sold. Remember the examples. IBM is a US company. When it issues a bond in USA, it is called domestic bond. IBM, when issues a bond in Japan, it is called international bond. And IBM, if it will issue bonds in many countries simultaneously, it will be called euro bond. Then bonds can be classified also on the basis of collaterals. Collateral is a very common term. We know that if we want loan, the bank may ask for guarantee. These guarantee are maybe of different types, but when we give guarantee or collateral, we can classify the bonds on the basis of the collaterals. Number one, mortgage bonds. Mortgage, the buildings or land, etc. When it is kept as collateral, it is called mortgage. So those bonds, those loans which are taken by the borrower by keeping buildings or land as collateral, it is called mortgage bond. Guaranteed bonds, where instead of collateral a guarantee is given. For example, a company is issuing bond, another company is guaranteeing, another company is giving a guarantee that in case this company is not able to return the money on time, then we are guarantors. This is called guaranteed bonds. Third is debenture. Debentures are bonds that have no guarantee or collateral, and the bond holders are treated as general creditors of the firm. No collateral, no guarantee, unsecured loan, and there are cases of debentures. So there may be big companies who give high interest and they take loan from the public, and the public is ready to invest because of the high interest, but the only problem with this type of a bond is there is no collateral or guarantee. And fourth, there are subordinated debentures. The bondholders are satisfied after the general creditors of the firm in the case of bankruptcy. Subordinated debentures are the fourth category of bonds based on collaterals. Who are these people? These people are the investors or lenders of money who give loan to companies, but they are ready to take very high risk and take the last place in the terms of return. So with this, they take very high risk because there is no collateral, there is no guarantee, and in case the company becomes bankrupt, they will be the last, just above the shareholders, common shareholders. So they take high risk, but they, that in the financial market there are many types of investors. There are investors who just want to, who take risk, who love to take risk, and they make money out of doing this. They become a smart expert in taking risk, and this way they make money out of taking risks. So these are four types of bonds based on collaterals. Okay. Bonds can also be classified on the basis of maturity. So there are two types, two names. One is putable bonds and the other is callable bonds. Put and call, there are two options in the futures market. The same is here and also in the financial market. If you remember, we studied about future and cash, futures and cash market. In the cash market, we immediately get the money. In the futures market, the money is paid after a time. So in the putable bonds, the bondholder has the right to ask for a payment of the par value from the issuer at specified prices and specified dates before the actual maturity. So, what happens is, in the putable bonds, the bondholder takes the money before the maturity period, much before the maturity period of the par value from the issuer at specified prices. So, what he does, he is giving loan as to a company and buying the bond and taking the money at par value before the actual maturity. In the callable bonds, the issuer has the right to ask to pay the par value to the bondholders at a specified prices and specified dates before the actual maturity. So, here the issuer has the right to ask to pay the par value. In the putable bonds, the bondholder has the right to ask for a payment of the par value. There are some terms we should remember which are related to bonds. One is called YTM, yield to maturity. It is the rate of return. It is simple, like ROI that we calculate on investment. YTM is the return on the invested money. Common maturities of bonds are short term up to 5 years, medium term 5 to 12 years, and long term 12 or more years. These are the different categories of maturities in bonds. Now, some more elements which technical names related to bonds, which are when you are selling and buying. One is par value, face value, nominal and principal. These are the amounts, the prices, the names of prices, the amount that has to be repaid at the end of the life of a bond. So, when the life of bond like 5 years, 12 years, 10 years is complete, what is the amount that has to be repaid? So, these are the terms associated with the matured amount. Issue price is the price at which the bond is first issued. Maturity date is the date on which the money will be returned. The coupon rate is the interest rate that the issuer pays. Now, it will be your duty to find what is it called or how is it done in sukuk. Okay, don't forget sukuk. Sukuk is the Islamic bond. Coupon rate is the interest rate that the issuer pays to the bondholders, and market price is the bond price in the secondary market when the bond is being sold and purchased in the market. Okay. Now, what we do, we quickly, because it is 9:05, we will quickly take the question and answers. And as I told you, we will solve this. I like you to solve on either on the group or by speaking. Let us start with both. Don't solve, don't write anything on the group, just speak or write on the group. And this week I will open a folder. You will submit this as an assignment. So, any student who couldn't attend the class, they must also submit this assignment in order to get the attendance. Otherwise, you will not get the attendance. And also, it is possible, I don't know, Wallahu alam, we don't know whether what will happen to the midterm or the final exam. So, that is why as a backup I am taking these assignments. So, in case there is no exam or anything, we have something to give a score for. So, this is, so what is the maturity period in money market? Who will answer? Very good, 1 year or less. And see, I won't be able to see the chats simultaneously. So, what you do, you either speak or write on the group. That will be better. Okay. So, who answered this question? 1 year or less? What was your name? Shuruk. Very good. Very good. Yeah. Okay. Question number 2. And as I told you, remember, you have to submit this as assignment this week. This this set of questions. Uh, okay. Do money markets have 1-day maturity? Yes or no? Yes, no, it has 1-day maturity also, from 1 day till 1 year. So this is, there is a, you should correct it. The money markets have a maturity of 1 day up till 1 year. Okay. Question number 3. Tell me, money markets have high liquidity, short term maturity, both or none? I think somebody has already answered. Sarah has answered it. Both. Money markets have both high liquidity, short term maturity. Okay. Answer 4. Which of the following are advantages of money market over bank borrowing? Tick all that are correct. A. Plays an important role in national and international trade, makes funds available for long term. Does it make fund available for long term? Yes or no? What do you say? B is yes or no, this one? Yes or no, this one? In money market, is the fund available for long term? Yeah, very good. Yeah, Shuk has answered. Shuk. Yeah, it is for short term. Then banks and other firms can invest for short term. Yes, it is true. And helps in increasing the use of cash. Increasing or decreasing? What is correct? Money market helps in, this is correct or wrong? Very good, reducing. So 2 are correct, 2 are wrong. A is correct and C is correct. Okay. Default risk means what? A, chance that the borrower will not be able to repay, chance that the investment loses value, chance that the economic condition goes bad. Which is right? What do you say? B, chance that the investment loses value. Any other answer for 5, question number 5? Manal says B and Dania Khalil says B. Any other idea about default risk? Default risk means chance that the investment loses value. All of you agree with this? One more B. What is default? Default means not paying, running away with the money. So default risk means it is a chance that the borrower will not be able to repay. The answer is A. Okay. Do non-banking financial companies participate in money market? Tell me yes or no. All from the lecture. Yes, very good. Rava has answered. Yes, non-banking financial companies, and you all know non-banking financial companies are those which are not allowed to take savings. They can give loan, they can invest, whatever they can do, but they cannot take in. Yes, they non-banking financial companies can participate in money market. Shuk has added one part to her answer. I am not sure what she means. Yes, if they went bankrupt, how will they participate in money market when they become bankrupt? But the answer is yes, they can participate in money market. Now let's match this. Commercial paper is what? Who will tell? You have to match directly from the lecture slides. Tell me, match this. Commercial paper is, which of these are correct? Very good. Unsecured short term promissory notes. Okay. Repurchase agreements, what are these? What is the correct answer? Let me just make it number so that it is easier for you. Yes, and this one will be ABC. Now it will be easier for you to answer. Okay, tell me. One commercial paper is C. Two repurchase agreements. Answer D. Yes, D. Good. Alanud and the one who shouted just now in my ears. Short term contract in which seller agrees to sell government security to a buyer and buy it back on a later date at a higher price. Okay. Certificate of deposits 3. What is the correct answer? B. Debt instruments issued by commercial banks. Very good. And last 4th, treasury bills, short term borrowings by government. Excellent. Okay, question number 8. Short term investment pools use proceeds they raise from selling shares to invest in various money market instruments are called. Who will answer this? Very good, excellent. Are you the one who wrote on the group, Sarah? You are? Okay, so both of you are correct. Money market, you should answer this question, money market mutual funds. Okay, and what I suggested, sukuk, mutual funds, these are some very important terms you should do your own research on, learn. If you wish to learn more, try to learn more, get yourself more familiar with these terms, do your research, share on the group. 9th, money market is a source of dash for institutions, credit or equity or both or none. Very good. Rava has already answered. Rava and Shok all are correct. Sarah, it's credit, loan. It's a loan, not equity. For equity, which market? Who will answer? For equity, what is the name of the market? No. What is the capital market is right, but more specifically, equity instruments are sold and purchased in which market? Stock market. Very good. Stock market. She didn't write her name, but it's good. Stock market. Okay. Question number 10. If the government prints currency rather than borrowing from money market, what will be the result? Sarah Abdu. Yes, Sarah Abdu. Good. If the government prints currency rather than borrowing from money market, what will be the result? Less savings, high inflation, high debt. What will happen? If the B, very good. Rava, very good. Rava has done very well today. She has answered many questions. Okay. High inflation will happen. High inflation means price of the products will go up. So that, yeah. Question 9, A, credit. Credit for institutions. Loan, we can also write loan. Loan for institutions. Okay. Okay, let's go to the next one, bond market questions. Let's do it fast. The time is running out because I opened this room only till. So if the room stops, don't worry. Now you can do it yourself. I think you can do the bond market yourself later because it will stop now in 9:30. Let's do it fast. Bond market deals in credit, equity, both or none. A, good. A, credit. The other names for bond market are credit market, money market, both or none. What is the other name? Very good, credit market. Islamic bonds are called? Islamic bonds are called? Very good, sukuk. In what ways bond market and stock market similar? Both have primary and secondary market, both have fixed return, both or none. Think on it carefully and answer fast. Fast. A, B, C or D? Bond market and stock market, they are similar. Are they similar in any way? Think on it later. The primary goal of the bond market is to provide, Shuk says none. No, both have primary and secondary market. Fixed return is only for bond market, not for stock, but primary and secondary market is for both. So, the answer is A. A. The primary goal of the bond market is to provide a mechanism for dash funding of public and private expenditures, long term or short term. Bond market, not money market. Bond market is for long term. Bond market is for long term, yes. Name the two parties in bond market. Who will answer? Two parties in the bond market. One gives loan, one takes loan. What are the names? Ish. No, not Sever. No. One party gives loan, the other party takes loan. So, the person who gives loan in the, yes, issuer, and the other name is Ravaiskar, bondholder. Bondholder, excellent. Issuer and the bondholder. Okay. Can companies issue bonds? Yes or no? Yeah, of course they can. So, yes, answer is yes. Question number 7, yes. One of the two companies in US that have AAA rating, you can check later. Microsoft is one company which has AAA rating. This is the rating of the bonds. Match. Okay. New debt, you know this answer. A, new debt, new bond in primary market, isn't it? And debt securities in secondary market. Dash bond is a bond that pays no annual interest. It provides compensation to investors in the form of capital appreciation. What is the answer? Zero. Very good. Yes, very good. Zero coupon. Euro bond is issued only in European Union. True or false? False. It is issued in multiple countries. The short term period bonds are of 1, 5, 10 or 12. 1 year. Okay. Which type of bond does not have any collaterals or guarantees? Tell me fast. We are running out of time. Which type of bond does not have any collaterals or guarantees? Debentures. Which type of bond are given less preference than creditors? Question number 14. Subordinated debentures. In which type of bond the bondholders can ask for a payment of the bondholder can ask for. Answer this. Can ask for a payment of the par value from the issuer. From the issuer. What is the answer? Putable bonds. Okay. Putable bonds. Then yield to maturity represents rate of return earned on bond held to maturity. A. Okay. Which price is quoted in the primary bond market? Issue price, market price, trading price or coupon price? Market price or issue price? Issue price. Okay. Name the 3 firms known for credit ratings. This is S&P and others. You can Moody's. You can write from. These are the firms. They give rating to the bonds because these ratings mean they are high quality or less quality. There is high level of default or what? High return. So, these are 3 companies who do rating of bonds. You can find from the lecture note. When a Saudi Riyal 100 is selling for Saudi Riyal 95, it is called premium or discount? Discount. This means discount in money market, in market, financial market means loss, and premium means gain. Okay. Which credit firm assigns ratings of BAA, BA, BCAA? You can find it from the lecture note here. I have given it on the group on the blackboard. So, you will go here, yeah, 14, which type of bond are given less preference than creditors. 4 types of bonds were there in terms of preference. Collaterals, one was with collateral, there is another with guarantee, the third one is without collateral or guarantee, and the fourth is without collateral, without guarantee, and they come last. These are called subordinated debentures. Subordinated debentures here. Mortgage, guaranteed, debentures, subordinated debentures. So, the bondholders are satisfied after. So, this is the answer for question number 14. And here you will see this, you have to read this lecture note also for answering the assignment questions. You can see here, these are the big 3 credit rating agencies, Moody's, S&P and Fitch. And you can also remember, you should remember that these are the terms for rating. So, Moody's assign bond credit ratings of AAA, AA. So, this is the answer, Moody's. Moody's is the answer for question number 20. With this we will stop, the time is also running out. I will stop yes, this recording is done, alhamdulillah, 1 hour 6 minutes.